The odds are very high for the biggest crash we've ever seen in stock market history. That's just a setup that I see. First of all, you had the fiscal cliff that I've talked about immensely. I talked about it all last year, and it's here. So you've gone from $6 trillion in helicopter money, almost all of it printed by the Federal Reserve, handed out to people. It's going from 6 trillion to zero. So you already have the economy slowing precipitously because of that fiscal cliff. Then into that, you have inflation at a 40-year high. You have interest rates that are spiking not only here, but across the globe. And look at BTB spreads to German spreads. So Italian 10-year notes to German 10-year. I mean, it's skyrocketing by 10 basis points per diem. This is unheard of for an Italian 10-year that was below 1%, and a German 10-year that was negative. The rates are soaring all over the globe. And then on top of that, you had a massive inventory build in Q4, which has to be drawn down, which when you draw down inventory, it takes away from consumption. So it's a net negative to GDP growth. So what I'm saying is the fiscal cliff, inventory build, highest inflation in 40 years, spiking interest rates are all adding to a trenchant drop in GDP growth. So we're going to go from 5.5% GDP growth for all of 21 to Q1 on a seasonally adjusted annualized rate, 0, goose egg. Yeah. That's a pretty big drop. And then you have earnings growth, which is going to go from 45% in 2021 to low single digits. Now, on top of all that, gentlemen, you have a monetary cliff coming. And on a rate of change basis, that monetary cliff will be the biggest cliff we have ever seen.
Yeah.
So we're going from, to be specific, $120 billion a month of QE towards the end of 2021 to 0. No new money added to the base money supply into the Fed's balance sheet by the first week in March of this year. Then we'll also have in March our first rate hike. You'll have another one in May and another one in June. So you think about a Fed funds rate at 75 basis points from 0 by June. And people will say, well, the Fed's funds rate used to be, 20. No, they don't understand calculus. They don't understand rate of change. It's the rate of change, not the actual level. It's how fast you're going from where you were from that base. So if inflation was at one time 15%, but now it's only 7, people say, oh, it's still half where it was. No, inflation used to be almost 0, and now it's 7. It's the rate of change that matters. And on top of everything I just said, with that monetary cliff, with the ending of QE, and then going into rate hikes, the most pernicious part of this is the quantitative tightening. I believe Mr. Powell and the FOMC will start quantitative tightening sometime around June, and it'll be around $100 billion per month. So it's watch out for what happens later this year. Later in Q2 is where I see the most salient portion of this decline and onwards. Somebody was actually saying from a major bank how there's no excesses out there. No excesses. And I'm like, he says the economy's deleveraged and the consumer is so healthy. So I just want to say, I want to leave you with 4 statistics. Non-financial business debt as a percentage of GDP is at an all-time record high. So nominally speaking, and as a percentage of GDP, an all-time earth-shattering record high. Margin debt as a percentage of GDP, all-time record high. The total market cap of equities as a percentage of GDP, an incredibly all-time record high. It's close to 200%. At the peak of the dot-com bubble, it was 140%. And real estate prices as a percentage of income are at an all-time record high. And this buffoon sees no excesses out there. That is why I say the Fed is forced to fight inflation, 40-year high, above 7%, into the most unsustainable and unstable asset bubble the history has ever seen. Triumvirate of bubbles for bonds, real estate. That is why I think this thing is going to blow. It's going to crash rather precipitously. And I don't want any part of that in my portfolio. I want to be out and short, net short in the portfolio when that happens. So when Powell acquiesces to trying to rebuild the whole asset bubble, structure of the economy back into place, I can go along with a much bigger pile of cash.